How's it going, everyone? It's Sam. Raoul Paul just spoke about what the heck is happening right now. Why is the market falling? What is going to happen next? The new banana zone. What are the targets? What is he doing? And I'm just going to play the video for you. This is coming from his channel, Raoul Paul, the Journeyman. Go subscribe there. Good content. But they put in a lot of time and money to understand these markets, which is why I want to play this for you guys. Now, before we get started, if you don't mind, just hit subscribe. Turn on the bell notification so you can see future videos from my channel as well. If you do want to trade crypto, this isn't right for everyone. Leverage trade is not right for everyone. But if you want to try to get these outsized returns, which we have been able to get using leverage, or even if you want to bet against markets, you can bet the markets are going up or bet the markets are going down, whether you go long or short. You can check out the link underneath the video. We're up 200% and just took some profits on a trade earlier today when we did catch the falling knife. Again, you can check out this link underneath the video, and let's get into the content.
You're all asking the questions, what the fuck is going on? Why are my bags being used? Where's my bananas? I want a market that goes up. So let's go. Now, the business cycle, remember I said, well, the business cycle is bottoming and not peaking. I know there's a lot of noise about recession. A lot of that was priced in back in 2022 from the forward-looking indicators. What we've got is the cyclical elements of the economy, car sales and stuff that are slow, miners and stuff that are driven by the business cycle. The business cycle is still chopping. Now, people say, yeah, but look, it rolled down. Yes, it did roll down. It happens at every low of every cycle. You tend to have this correction, and that's where we are now. So you can see the last 2 decades worth, you get this secondary dip before you get the recovery. So that's where I think we are now. It's kind of noise because most of the markets I concentrate on, crypto and technology, are priced off liquidity conditions and financial conditions. But we are at the relatively slow point of the economy where rate cuts are now kind of preordained, and the things that back it up are things like unemployment. I've been talking for a while that unemployment should rise. I don't think it's going to go super crazy, but now we're at the point where we're beyond the unemployment rate of the most negative Fed member. So obviously the signal is there to cut rates, and the Fed have made that clear. Maybe they come sooner, maybe they don't, maybe they inject liquidity in different ways. But either way, unemployment has been rising, and that is a key factor for the Fed, and inflation has been falling, which is the key factor for the Fed. So it's green lights all round to cut rates, and cut rates allows liquidity to come in to the system. So what happened is this mix of the DXY, which is the dollar, and the 10-year bond yields, and Fed rate cuts all came from the Fed starting to suddenly say, well, the market's starting to realize the Fed were going to change course, and then the Fed changing course by saying they were probably going to cut at the next meeting. And that set this whole thing off. Now, there's a lot of rate cuts priced in. They weren't priced in before, but I think they're more correct in how they're pricing things in. Will it work exactly how the markets are suggesting? I don't know. But I think rates come down to 2.5% or lower in this cycle. If you remember, the everything code needs low rates because you have to refi the $10 trillion of debt. So you need low rates to do that and liquidity to pay the interest payments on the prior cycle's debt, which is why the everything code is so important in this and why we keep repeating the same old cycle. It's because it's about paying the refinancing costs of the debt, and we're deep into the refi cycle. So I've been explaining for a while, the Fed and all the central banks need low rates. The Treasury needs liquidity within which to roll that and also to monetize the previous interest payments. That monetization of interest payments is what drives the liquidity cycle and the debasement cycle, which drives up assets. Also, as the business cycle bottoms, people have more money, businesses have more money, gets reinvested, people invest more, and that builds on a cycle. Things like emerging markets do well when the dollar weakens. So therefore, profits get reinvested in the system, and the virtuous cycle of macro summer and macro fall play out. And that should play out all the way into the end of 2025. Okay, financial conditions are really important. So financial conditions lead the ISM, the business cycle, by 9 months. So we've been ripping higher in financial conditions for a while now, with some pauses en route. If you look at the current pause in the ISM, it matches the pause we had in financial conditions 9 months ago. But now it's been going higher. This financial conditions index doesn't take into account the fall in yields that happened this morning and the fall in the dollar. So by the end of the week, if those stick, we should see this even higher. But overall, as the dollar weakens and rates come down, financial conditions will continue to ease, and that will continue to lead the business cycle 9 months from now. Also, what the financial conditions is really gives you a composite of all the countries with their leading indicators rising. So it leads somewhat, and it's telling you that economic recovery is on the cards. And that's what these OECD composite leading indicators are. They're showing you that global economy is recovering and financial conditions is what causes it to recover, which is important because that's where profits come from. That's where earnings come from in corporations. That's where household earnings comes from. That's where investment comes from. Money goes into the stock market. All of those things are driven by this business cycle. Okay, when we look at the global liquidity, you hear about me talk about global liquidity a lot. Well, you see, financial conditions lead it. The central banks pretty much act on the financial conditions. So there's a 5-month lead. So you can see financial conditions on this weekly basis have been chopping around a bit, but are moving higher. And that should mean global liquidity should follow. And financial conditions should be breaking out once the numbers are updated. And that will have the liquidity also rising. So liquidity is the prerequisite for markets to rise. And so that is all coming into the play. And now we've been given the reason. You know, people say, well, we need something to break. Well, guess what? We had it today. So we've got that. So global liquidity, when I look at it, global liquidity is about to break out too. I know you might think of this as a sin, doing technical analysis on the global liquidity index, but hey, it just shows the sideways contraction in global liquidity and the likelihood that it plays out, driven by the US, driven by Japan, driven by China, and also eventually driven by the Europeans and everybody else, because they all need to refi their debts. That's the big game, the everything code game. And global liquidity drives crypto. So if global liquidity is going to break higher, crypto will too. So if you've got to think of these moves that we're seeing currently as wiggles on the path of the main trend. And what you tend to do, it tends to overextend in bull markets, and we should see that in due course. So as global liquidity rises, cryptocurrencies will rise, as will other markets like NASDAQ. The other thing is global M2. Global M2, many of you have pointed out, is starting to rise. It's starting to break out. As that breaks out, that's led by financial conditions. So global M2 is rising, another liquidity measure. Global liquidity is going to rise. Financial conditions are going to rise. Okay, this is what we're looking to see. This is the macro summer signature, the macro fall signature, the times when debasement comes, the times when assets do really well. You can see Bitcoin, how sensitive it is to global M2. As global M2 starts picking up, Bitcoin year on year should start picking up too. So again, I don't see anything concerning in the macro picture. The macro picture is incredibly supportive of higher asset prices. So that's why I think we're dealing with a spasm and not a regime change in macro, where we're going into a recession or something like that. In fact, it's the fears at the bottom of the cycle that's causing this. As the cycle starts to rise and things like the dollar needs to start weakening, it's not fears the other way around that the cycle's about to fall apart. You can see the financial conditions index also affects S&P 500. Equities are driven by financial conditions. So there's a 6-month lead here. So as financial conditions start easing, that's the number going up, the S&P 500 should follow suit. So again, we expect to see stronger equity markets ahead. Emerging markets, they're driven by financial conditions, 6-month lead. Emerging markets really are a function of the dollar, which is part of the financial conditions index. Financial conditions Our measurement is the dollar plus rates plus commodity prices. And we're seeing those ease, and that should put emerging markets higher over time for those of you who trade them. Tech stocks, 6-month lead, same thing. Tech stocks have been correcting and had obviously overshot financial conditions somewhat. And again, we should be looking for a base over this period of time. This volatility, for those of you who aren't kind of max allocated to this stuff, this is the opportunity you're really going to want, because NASDAQ, again, should take off from here around these kind of levels. Now, again, I'm not talking about today or tomorrow. I'm talking about over the next 3 or 4 weeks. We should start to see liquidity coming, financial conditions coming, and equity starting to scream higher again. The big driver here is the PBOC. Right now, the PBOC have this cyclical pattern of every second half where they start injecting liquidity into the system. Additionally, we know they have a bigger cycle, much more like 2020, where they've got to deal with the debt deflation issues at home. So they're going to have to do quite a lot of easing, and they're going to do quantitative easing, and they're going to do all the liquidity measures necessary to drive their economy up. You see, without the Chinese economy, the global economy is a bit fucked. It's one of the key legs. So the Americans, the Europeans, the Japanese, everybody knows they need China on the game. And so China is now on the game doing what it's supposed to do. And we'd expect that to continue over time, particularly now that the yuan is starting to strengthen against the dollar, because the dollar's going down thanks to the Japanese. It allows the Chinese to be more aggressive, which everybody needed. Okay, so you guys are freaked out by the volatility. I've tried to explain with my don't fuck this up thesis that 35% pullbacks are normal and sometimes more. You see, often in crypto markets, we get these, and really they're opportunities to add and not freak out. This is why I urge the longer term time horizon. So I've been in this market at 2013. So I'm going to show you all the times I've had to deal with volatility like this. So here's a nice one. 2013, I got in around here. It then had a 71% pullback. Now, this is early stage. So this is like a smaller token now, probably something smaller than Solana, more like an alt would trade. So in what looks like a sideways market, it actually did a down 71%. And then it did a 15x into the end of the year. So that's kind of how alts act in this. This is when Bitcoin was essentially an alt. It was a small cryptocurrency, not yet with full adoption, not yet proven. Okay, then we go into the 15-17 cycle, which I think is a very comparable cycle to now. We talked about 2016 with the spasm. Well, before that, we had a sell-off of 35% in 2015. So that will be something from last year. If we think about those cycles that repeat, the election years are always the macro summer years. So we'd be in 2016 now. So 15 would be last year. Guess what? We had a sell-off last year, and then we had the rally into the end of the year. Okay, very similar. Then we had this 40% pullback around the banana zone. The boring zone. So this is the boring zone area where around the Bitcoin halving. And that period, you saw a sharp sell-off, pretty nasty, and then eventually it broke high. And then we had another 38% pullback before you really got into full bananas. That's how this works. The banana zone is not about here and today and break out immediately. It's a process by which prices accelerate over time once they're free of the ranges that they're in. That does lie ahead. I know there's a lot of people like, oh, Raoul, and you're fucking bananas, you're a top signal. Listen, you're not listening. This is not a short-term timing signal. This is the structure of markets I'm trying to talk about, and I'll show you a bit more on that. But that was that cycle. There was some pretty brutal. There was 35 to 40% pullbacks. And what a cycle that was. By the end of 2018, this thing had really flown. Okay, so this is the 2017. That was after those corrections. We had 4 more corrections of 30 to 40%. 4. So this should be sort of where Solana is now, where the size of the corrections, that's the sort of liquidity Bitcoin was, the size in market cap it was then. So this is, we're seeing similar in Solana now. Bitcoin is now much larger market cap, So its volatility is compressed. But this should be looking like Solana, where you start to see these sharp 30-40% pullbacks, and they're just pauses that refresh, and you keep going higher as the banana zone kicked in. So even with 30-40% pullbacks, Bitcoin went that year from, I don't know, I'm just eyeballing the chart, 1,200 and ended up at 20,000. Okay, I'm not saying we're going to repeat that, but this is the kind of thing that plays out. So if you're dealing with too short-term time horizon, trying to top and tail it and time it, I think you'll fuck it up. I simply do. I think you'll miss the move. The best thing to do is to try and scrape the sofa for change and stick it in the markets when you get a sell-off of any magnitude. Because guess what? It compounds really fast and the gains come much faster. You'll be back at all-time P&L highs before anybody else. That's why I prefer to add on the dips and not try and trade it around, because often you get sidelined just when you shouldn't and the market's ripping and you can't get back in. Okay, 2019. Well, that was a tricky one as well. We had a 54% pullback in Bitcoin between June and December. Then we rallied, and then we had a 62%, and that was obviously COVID when the world shut down. So you've got to be prepared for the volatility to be able to deal with these things. I don't think we have a repeat of 2020, but 2019, you know what? It's possible. I don't think that to be the case, but maybe something more protracted in the Middle East could cause something like that. But again, in the end, if your time horizon is long enough, it doesn't matter. And if you can buy, that's when you make generational wealth. So, real wealth, how to unfuck your future, is to take advantage of the sell-offs and not fear them. As long as you're in spot, not using leverage, you're not in the stupid last cycle shit. You're in the coins that matter, the top tier, the top three. I know you've all got your favorites. You want XRP to do it or Cardano and everything else. I urge you just to be slightly more conservative. Conservative still means huge gains, but I don't want you to miss the opportunity or to get carried out just when the opportunity is arriving. So those are the corrections. Then we saw in 2021, two corrections. One was 31%, one was a gigantic 55% before it went back up to new highs, and then we had that kind of stunted high. So the point being here is expect corrections. You can expect anything between a 30 and a 50% correction to happen, and you shouldn't be fazed by it. You should be actually looking forward to them. So that's what we're doing now. That's the kind of cycle we're seeing now. Now, I wanted to go back also to ETH, because ETH was a smaller token back in 2019, 2020, and we had a 67% pullback when Bitcoin had done 51 and a 68 when Bitcoin had done 62. So more volatile, earlier stage tokens tend to underperform on the downside and outperform on the upside. So just keep that in mind when you've got your asset allocation, which is why I'd rather hold the bigger tokens and not have too much stuff further out the risk curve. Memes are fun. I own some memes, but I don't own more than 10%. And that's what I've said to you is, please don't own more than 10% in the stupid liquid stuff because you think it can do 100x. I understand that, but it'll still make you a lot of money if it's less than 10% of your portfolio. But it won't do if your whole portfolio is those and it goes down 99%. Again, it's part of this don't fuck this up thesis. It's super important. So let's talk about the banana zone, because everybody cares about banana zone. All of our hopes and dreams are in it. And I don't want the stupid fucking, well, you promised bananas. I've never promised bananas immediately. I've told you this is how it plays out. This is a period of time. I've also talked about the boring zone. So you've seen this chart before, but now we've just added the percentage corrections in the boring zone to make it even more clear to you guys how this works. So boring zone 2012, 27%. Boring zone 2016, 38%. Boring zone 2020, 20%. Boring zone 2024, 27%. Right, so it's smack in exactly what you'd expect. And what comes next is the banana zone. And I don't want you guys to miss it because you're getting caught up in short-term time horizons of traders on Twitter. That's their time horizon. Nothing wrong with being a trader. I just don't think you'll make as much money. So I think you're better off to think of the long-term gain is how do I use these kind of opportunities to put as much money in as possible so I can capture the big upside when it comes. And I've shown you why that's not just a hunch based on these charts, it's actually based on the everything cycle. And that this macro spasm is actually the opportunity to really think about this, how you want to get involved, where you can find money to add, how you can get your portfolio set. It applies to tech stocks, it applies to equities overall, it applies to emerging markets. All of these things are setting up perfectly, even to commodity manufacturers, mining companies, any of these things, car companies, all of the cyclical plays, they're all driven by this. So this is the opportunity that you've been asking for. This is the last chance to be able to do all of this. So I look at these with glee and say, thank you. All I need to do is find some money to put in because I'm max allocated, but I do have an income. So, I try and scrape my bank account for any excess that I've got that I won't need over the next few months and stick them into markets. I mean, I don't sell anything in crypto. I've not sold anything, meaning my overall portfolio at all since 2020. And I just continue to compound and add, and that's worked for me really, really well. For those of you who keep asking, no, my allocation hasn't changed. It remains that my core portfolio is in Solana. I have some memes, which are Church of the Smoking Chicken Fish. I have WIF, Bonk, some Doge. And if those go up and down 80%, it doesn't matter to me. It's fun. I actually think they'll do well. You may have a different token. They're not my recommendations. I'm not trying to shill you into buying anything like that. If you just want to stick with Bitcoin, it's fine. Ethereum has been a hairy ride. Now, part of what's been going on is jump trading have been dealing with legal suits with the SEC, CFTC, and others, and are closing up shop in market making in crypto. And they've been fire selling everything. And that's created a huge overhang. A lot of this boring zone has actually been the overhang of selling by Grayscale as they unwind the trusts, Germany selling Bitcoin, Mt. Gox selling Bitcoin, the FTX estate selling Solana and other tokens, and then jump trading. So that's what's been causing this really. This last spike was this macro spasm on this small macro shock. And again, let's see, because, let's see what happens with the Iran-Israel situation, because that could create another period of fear. But generally speaking, you get fearful of the rhetoric and buy the bullets. That generally has worked in markets over the years, although, trading war is never not something you want to aspire to. But that's how it generally works. So the boring zone, driven by excess supply. Also, we've got a lot of token unlocks from newer projects. So all of that supply, plus all the amount of memes, has taken a while to digest. Liquidity will digest it. Think of it as eating up all of the supply as the holders from the last cycle where things went wrong, like the FTX estate, etc., start divesting those assets, putting them into stronger hands, allowing the markets to rise over time. So where are we in markets? Well, here's the Solana chart. I believe we've been building this inverse head and shoulders, which is a large pattern. And we've been having this kind of rectangle move on the side. We retested the neckline. It popped through today. When it got down to wherever it got to 105 or something. I think this probably holds. It doesn't really matter because I don't really trade the daily chart. But this kind of consolidation pattern in Bitcoin, it's a part of a larger cup and handle pattern. ETH looks a bit messier, but maybe that's going to give us better opportunities. The other part of my portfolio is I've been buying the high value NFTs from great artists that I think are going to maintain value over the next 10 and 20 years. So I will use this opportunity as well to probably add to my NFT portfolio, because ETH versus Solana has come down and I own a lot of Solana. I just need prices to come back up again a bit, and then I'll do some allocating there. So hopefully I've shown you that these things are scary. I get it. These are not nice to deal with. You're all asking the questions, what the fuck is going on? Why are my bags being used? Where's my bananas? I want a market that goes up. That's not how the world works. The world works however it works. Your job, and the job of every bull market is to throw you off. Your job is to not part with your tokens. I've explained this many, many times. That is your single job. If you can just not fuck this up, keep hold of your tokens, and then eventually the banana zone comes and we can realize some of our hopes and dreams. Now, obviously, there is a risk that that may not happen. I don't see it in all of the macro work.
Now, what do you think? Do you agree with Raoul Pal? This is a good time to be dollar cost averaging, or are you just sitting on your hands? Let me know your thoughts underneath the video. He says he's max allocated. I think that means max allocated for what he's comfortable with. He continues to put in more, it looks like, during these times of big dips. And I just saw an interesting stat. I'm going to talk about this in an upcoming video, but coming from Mike Alfred, investors who have purchased US equities whenever the VIX is above 50, which it went to 60 today, have never lost money over the following 12 months. Now, that's not always going to be the case, but that has been the case in history. So if you are buying today, at least with equities, typically that's been a great time to buy. Let me know your thoughts, though, underneath the video. Again, if you want to trade crypto, you can check out the link down below to Margex, and I'll see you all in the next one.